Hello traders and welcome to a new video series of mine. In today's video we're going to be going over how to hunt other traders' stop losses and profit off of their exiting positions. So to begin, as per usual, we're going to talk about the winner of the challenge. So congratulations to Blue Doe Perk, I don't really know how to pronounce it. This guy gave a killer prediction for Neo, I must say. This is what he thought. He predicted that we would move below channel and then up to 75.34 using the 1.618 of the high to the low. This is what actually occurred. 75.34 is that horizontal trend line that you see here. He was very, very close, and he actually nailed the first market reaction here, where price went to 75.3, moved down, went up to a high of 76.25. Really good prediction here, I must say. Only mistake was that price did not go below the channel. It stayed within this yellow channel that you created. And as you can see here, the channel would have held, and the Fibonacci 1.618 would have been a good place to sell for that market reaction. So congratulations to you. All right, let's start with stop loss hunting. I had two options when making this, when researching and making this video. I could either just go the route. I could have either just gone the route of buy below support, sell above resistance. Sell when price makes a higher high, buy when price makes a lower low, right? Because that's where stop losses will be, below lows. But I wanted to do something a little bit different. What I did was I combined Wyckoff market theory with stop loss hunting dynamics to try to find this kind of blend between the two that's simpler than Wyckoff theory and also can be applied to many different kinds of markets. So this is a theory that I've created, and it's quite simple, and it can be applied to many different kinds of markets, as we'll see. So before we talk about the 3-point and the 4-point market structure, that's what we're talking about today, the stop loss, reversal structures, and continuation. I want to talk about why stop loss hunt occurs and why they're always going to have to occur. Well, the market's going to have winners and losers. That's just the way that the market operates. It's not exactly a 100% zero-sum game like poker, but it will have to have some traders filling liquidity of other traders at bad prices. So how does this occur? Well, imagine that you're an institution and you need to buy 100 Bitcoin because you believe that the market's going to go up. You may have more information than other traders do. So how do we do this? One big mistake that you might make if you have 100 Bitcoin is putting a limit buy order at the middle of consolidation just at the best price possible. What's going to immediately occur is other traders and HFTs are going to front run that order like this, and you're not going to get your order filled. Even worse, part two, if you get all 100 Bitcoin market sold to you, what that probably means is that there's a large amount of supply, meaning many traders who are eager to sell, both institutions and retail. And if they market sell 100 Bitcoin to you in the middle of consolidation, that typically means that there's enough bearish pressure just to push price lower. So that's probably not going to be great. What we do instead, if we're an institution, is we want to look for a pool of liquidity. We want to look for a spot where many traders will market buy or market sell, right? Because we need someone to market sell to fill my limit buy order. So to do this, this isn't evil or anything immoral. This is just how the market operates. We need liquidity pools, and these are going to be located where many retail traders' stop losses are. And if we can place limit orders right by those clusters, then we can ensure that we can get many stop losses that trigger as market orders to fill our liquidity. And beyond stop losses, another benefit to the institutions is convincing retail to act and convincing retail of a certain market direction. So what I mean by that is, what's the psychology behind a higher high, and what's the psychology behind a lower low? Well, what happens when a higher high gets formed? As you can see here, higher high, boom. Shorts are going to have their stop losses hit because they're going to put their buy to cover stop losses above, if they short here, they're going to put their stop loss here. That's going to get hit. Buy to cover market order. Second thing is sideline traders may want to market buy. They see strong bullish move above a high. They just believe that this is going to be a continuation of an uptrend, right? Looks healthy. We broke the resistance here on great volume, great momentum. This looks good. Price was at one point here. That's the point that I'm talking about before it had the swift bearish reaction. Shorts may reverse their positions to the institution's delight. What this means is they're going to market buy just to exit their position, and then they're going to market buy again to actually enter long. And what this is going to do is just basically like a double market buy, to think about it ratio-wise. The fourth thing that's going to occur is after the market produces this higher high, retail traders believe that when the market goes back down, that it's just simply a retracement to buy on. So this looks like this. When the market began to move down here, and even when it began to move up here, this is convincing many traders the market broke through resistance here, and the price will likely just continue moving upward. So they're going to begin to market buy, filling the limit sell orders of institutions. The fifth thing that's going to happen is that traders are traditionally taught in textbooks, in other YouTube videos, or other articles that a higher high signals strength. I don't want to say that a higher high signals weakness or strength because both are incorrect. The most important factor behind deciding whether when price makes a higher high, is it going to continue moving in that direction or not, is the immediate reaction to after that high is created. If you see the immediate reaction is a tail like this, and then imagine the market's here at this point, this is not a confident bullish move. This is likely just trapping retail traders and hitting other shorts stop losses. So that is actually going to be an example of a higher high you do not want to buy into. However, over here, I would say at this point, when price confidently goes above, high momentum, high volume, and closes and does not have an immediate bearish reaction back into the trading range, yeah, this is signaling bullish strength, but this is signaling bearish strength. Okay. Same dynamics with the lower low. So longs are going to have their stop losses hit, so that's going to come here. Let's say I buy in here. I buy in when I'm beginning to see that bullish strength. I think this looks good, right? Awesome. And then price goes below support, hits my stop loss. Sideline traders may market sell or enter short because they don't know what to do. They pick a direction and they see price going lower, they'll short. Longs are going to reverse their positions, and after the market produces this lower low, retail traders believe that when the market goes back up, just a retracement that I can sell on. And they're going to begin to market sell here or limit order sell to, which is going to fill many orders of institutions who want to limit buy. After we get that, we get traders taught that lower low signals weakness. Again, same dynamics as higher high. They believe that when the market goes a bit lower than here, that means that the market is weak and likely to continue moving downward, when exactly the opposite is going to occur. And this is just how the institutions can fill their liquidity for their buy limit orders, right down to here. And here as retail begins to market sell, as you can see here. Now I do want to say, we're going to be talking about a 3-point structure and 4-point structure, but I do want to say a few things that are pretty interesting. You may wonder, okay, cool, Bennett, but why didn't this market structure actually go higher? Because this looks like the same thing as this, right? Very interesting detail is actually divergent of this. We made a higher high here, and then we went down, right? Because we made a low, we made a high, we made a low, but then we made a higher high. So this could actually be convincing retail that the market's going to go up, causing the market to go down. Not the same here. We make a low, we make a high, we make a lower high that doesn't fill any liquidity up here, and then we make a lower low. This is a 4-point structure, and this is why the market went up here, because we weren't able to break the high. And that is exactly why, as you can see here. And one more thing that I just want to add in before we move on. Notice here price makes again, this was our initial example, but price here makes barely a higher high, right? And then it goes down. So once the market believes, once the retail is convinced that the market's going up, because this point is where they said, all right, I was wrong. I thought the market was going down. I'm going to retail buy. A lot of them are going to retail buy here, and a lot of them are going to potentially retail buy into this structure. They're just going to fill the limit sell orders of institutions who get to fill hundreds, if not thousands, of orders from convincing the market that the market's going to go up, convincing retail that the market's just going to go up, and many retail traders get trapped. Here. Beautiful, not beautiful, but the structure is beautiful. What's actually occurring in the market is kind of a little bit more sinister. All right, now let's talk about the direct market structure that I alluded to previously of combining Wyckoff market theory with stop loss hunting. And like I had said, I do need to say this disclaimer: do not just buy when price makes a lower low. That is a terrible idea, really bad idea. You have to see a certain structure occur so that when price makes that lower low, you can be confident with a high probability that the market will move up and that we've hit trader stop losses. There are many examples of just price just going down, making a low, just going lower. That's not where you want to buy. So it's this kind of structure that tells you when Do I want to pass or even short? Or do I want to buy? So this is known as the 4-point previous uptrend turning into a continuation. So we have a previous uptrend. And now this is going to actually turn into a continuation. Why? Well, we get H1, high 1. This is the buying climax of the previous uptrend, typically accompanied by volume spikes, high tails, and a swift bearish reaction after the high is created. When I say swift bearish reaction, I mean that once the top tail is created, we should see a strong move back down. I say that because if you actually do not see a swift bearish reaction, and we're here, say that the market barely moved down, the market could just move higher, and this couldn't be the end of H1. Because typically, more often than not, when the market consolidates at resistance or consolidates at support, typically, if it consolidates at support, it'll just continue moving downward. If it consolidates at resistance, it'll just typically continue moving upward for a long period of time. Because that shows that I don't have enough time in this video to explain the direct dynamics of that, but that's just one of those, like, more often than not, as you can see, consolidation a little bit above resistance, price goes up. Okay, so weak bearish move downward with L1, ending with low tails and minor volume spike. So this is the swift market reaction, and then we get this L1, so low number 1 being formed. We do not see really high volume here. I see very, very low volume. The only volume spike I see is this low tail here. Low tail and minor volume spike. Then we get H2. H2 is going to be indicating to us and institutions that the market might be going higher. Bullish strength. This is going to retrace to at least the 61.8 Fibonacci retracement drawn from H1 to L1. H1 to L1, here to here, this should be at least a 61.8. This will occasionally end in a minor volume spike, as you can see as well. This one doesn't, but it does end in a high tail. And we get to my favorite part of the 4-point structure, the spring, the shakeout, the fake out, as they call them. This is the lower low being made. This is where price moves lower and then immediately back into the trading range above L1. Yep, we see that here. At this point, price had moved back into the trading range. And you're either going to see a large volume spike with a low tail or low momentum accompanied by low volume. We see both here. I see very, very low momentum and very low volume here, like none, below moving average. Then I also see a volume spike, a minor volume spike with this tail, boom, and with this right here, boom, right here. So what that's going to do is convince retail that the market's just going down. This is going to convince many sideline traders just to sell. This is going to convince any traders who don't have stop losses to sell. This is weakness, right? And the market goes up. So let me just say for 30 seconds why this occurs, because again, I explained the psychology, I explained the structure, but direct mechanics of why this occurs. Many retail traders might be buying in here. Institutions don't want that. They want to buy themselves. They don't want other retail traders buying liquidity that they could buy from. So what do? Well, they first convince them that this looks quite bearish. And then after that, retail traders might be shaken, but not stirred yet. And then some retail traders might put their stop losses below support and believe the market moves higher. At this point, this kind of structure could be when other traders begin to short or begin to sell. And then if a retail trader hasn't sold or shorted yet, when the market begins to move back down here, and especially when it moves past support, this is going to just force a lot of traders to act. And they're typically going to sell because this is going to look bearish. Imagine if you hadn't seen this. We just saw this. This looks pretty bearish to me, right? I mean, actually no, but if I was a retail trader, then yeah. Well, I am a retail trader, but if I was a beginning retail trader, then I would believe that this is quite bearish. So that's the mechanics of why. This is just all going to fill the limit buy orders, also known as bids of institutions as retail market sells to them. And then price goes higher, as you can see. But I do want to say, just one more note here. Yeah, you may say, hey, price made a high, why did it go lower? Well, here, look, strong momentum, strong volume upward. Price does not close back in the trading range. Nope, does not. And then, obviously, the price is going to go higher. Here again, price makes a higher high. Does it close back into this range? No, and it makes a higher high. So you need to look for these like tiny details that the market's going to be giving you information on, especially if price closes back in the trading range like it did here, and that's where we want to buy, or if the market actually doesn't close back in the trading range, something like this. Okay, now let's talk about a slightly simpler concept, the 3-point uptrend reversal. We have a previous uptrend, and then we should be seeing 3 points. H1, L1, H2. H1 is going to be the exact same as H1 of continuation. This is going to be where a buying climax is going to occur of the previous uptrend, typically accompanied by a volume spike, high tails, and a swift bearish reaction after the high is created. Swift bearish reaction, high created, quick reaction back downward, trapping some retail longs, and convincing others to short, or convincing others to sell here. And then any traders who sold, any traders who thought the market was going to move down, price goes up, breaks the high, convinces them that the market's got to go up, high momentum, everything looks good. Market goes back down, just a better price to buy on, right? And then this happens. Market goes down. We've convinced the retail traders that the market's going to go up, so we push the price down. This is what institutions will do. So L1, we get that bearish move downward carried by above average volume and momentum. This is a slight signal to us, this higher volume here, that price might actually have another bearish reaction much, much lower. And then H2, again, my favorite part of the 3-point and 4-point structure is the end, the H2 and the L2s. Higher high made, price breaks high on weak momentum and weak volume, and price moves back in the trading range. Textbook right here. Volume below the moving average, weak momentum. We should be seeing very, very high momentum if price moves above a high, right? Something like this, or even like this, high momentum. No, we don't see high momentum at all. We see actually a swift bearish reaction back in the trading range, trapping some traders here into long positions. Then we get the market to go down. Simple as that. Well, not simple, but that's what it's going to look like. All right, now let's flip the gears and talk about downtrends. So it's just going to be the opposite for a lot of these points, but it's still important to go over. 4 points in a previous downtrend that turns into a continuation of that downtrend. So here, we've previously had a downtrend. We see a low, we see a high, we see a higher low, and a higher high. Typically, this kind of structure is going to be quite bearish, even though to many retail traders, it might look quite bullish. Here's why. Selling climax of the previous downtrend is going to be L1. This is typically be accompanied by a volume spike, low tails, and a swift bullish reaction after the low is created. Swift bullish reaction, and we got volume spikes. And we have low tails for L1. Perfect, right? Weak bullish move upward with creating H1. High tails and minor volume spike. Yeah, high tail here, high tail here. We don't really see a minor volume spike here, but we do see a bit more in the move downward. L2 is going to be the higher low that's made. This is going to retrace to at least the Fibonacci retracement of 61.8, drawn from L1 to H1. So drawn from boom to boom. This move here should be at least 61.8, showing bearish strength to us. And this will occasionally end in a minor volume spike, as you just saw. And then again, my favorite part of the 4-point and 3-point structure, the H2 and the L2s. Higher high made, price breaks high on weak momentum and weak volume, then price moves right back in the trading range below H1. Price moves here, makes a tail, minor volume spike. Price moves right back down, swift bearish reaction below H1. And we get that. With a 4-point kind of structure, price moves here, and then this is signaling very, very high bearish strength, as you can see right here. Okay? And that's what a continuation is going to look like, as you can see here. All right, let's talk about the last point before we go into some practice examples. So we get L1, H1, L2. Let me show that. This is what a downtrend turning into a reversal is going to look like. L1 is that selling climax, same thing. Going to typically have a volume spike, low tails, and swift bullish reaction after the low is created. However, I will say that what I have noticed is that when the market reverses, so like a 3-point, typically the selling or the buying climax is going to have higher volume than for a blow off, oversold or overbought, than for continuation. So typically I like to see these, my L1 and my L2 to have a lot of volume being transacted. And same with the 3-point reversal here. I like to see a lot of buying volume here and a lot of buying volume here. But in continuations, I actually want to see a lot of buying volume here and buying volume there. But typically it's not as much as a full-on reversal. I just want to put that note in. Yep, so typically then we get H1. This is going to be a weak bullish move upward, typically ending with high tails and minor volume spikes. H1. We don't really see a tails, but we do see a minor volume spike above the moving average. So that's why it is minor. And it's not 3 times above the moving average, so it's not a major volume spike. Then we get L2. This is going to be a lower low that is made that typically ends in a volume spike and low tails, or it will end with weak momentum and low volume. And as always, price has to close back in the trading range. So we see a slight low made. Remember, we have to see slight lows or slight highs made. We don't want to see price just zoom and past level. That's probably not a stop loss hunt. That's probably something maybe a bit different or different kind of structure. But L2 is going to be a stop loss hunt. The entire intention of this move is filling the limit buy orders of institutions, as I've mentioned probably like 20 times. And that's what we see. We see here high volume, low tails. Right? High volume, low tails. If this price had actually closed here and then it moved here on high volume, that would be high volume, high momentum. And price would just likely go lower. And if you're curious, where do I buy in? Well, these kinds of reactions are where you want to buy into. This is where the retail is. This is the last chance for retail. If you haven't sold already, that retail thinks, I'm going to sell here, right? This looks quite bearish. Market made a low. We're just going lower. They're going to sell here, and you could put your limit buy order just to fill as they sell to you. You could be incredibly aggressive if you want. Don't recommend this, though. Put a limit. If you see an L1 and then an H1, you believe that an L2 is going to form, you could put your limit buy order directly above L1, like here. That would be dangerous, but you would be filling with no fees or low fees, and you would be filling at really the best price possible. But if you want a higher probability chance of success, wait for price to close back in the range. We want to see bullish strength and trapping of retail traders. We don't exactly know what's going to happen until we get the 3-point structure. So this is a good spot to buy in, and you make that money. Looking at other reactions here, I can see a few things just occurring. Like if we look at this was just classic, dirty thing in the market again. High, low, higher high, price goes down, right? And then I think I saw another example here. Yep, so we got a fake out here, and then we went higher, and then we got this structure here, as you can see. Okay. So I think I did want to say one more thing before we go into practice about one of these examples here. An example on highs and lows and when to identify when a high is being created, when to identify when a low is being created. So yeah, I think this is the example here. Let's say that you were just here. I mean, you don't know that this is going to occur. You have to wait. If you label this H1 and then this L1 and then this H2, you would have, when you see this kind of reaction, you would have to ditch that count, if that makes sense, that 4 count. And you would actually have to say, okay, this is not L1, this is not H2, this is L1. And then after you get that, let's say when the price is here, then this is when you can say H1, L1, H2. It's much more clear. And then you're waiting for L2, and this is where you strike. You execute your order. But this is just a quick little way that, sometimes your counts will be wrong, but price will show you when your counts are wrong. And if you're not aggressive and you can be a little bit more conservative, then you don't have to trade until your count is proven correct. So if you try to do a 4 count here, or even a 3 count, this would be incorrect because you'd have to wait for that. Yeah. Okay, let's go to practice. So this one is basically one I just already showed here, but again, we see a previous uptrend turning into a 4 count continuation. High, lower high, low here, lower low. Great volume here. We see a volume spike with price moving immediately back into the trading range right here. We see a slightly lower low that's very clearly a stop loss hunt just to fill the liquidity of institutions. Reaction right into it. And you want to buy. This whole structure looks quite bullish, as you can see. Again, one more. I'm going to ask you guys this one. Do we think that this is going to be a 3 count or a 4 count? Again, a 3 count would mean a reversal. A 4 count would mean a continuation. And the previous trend is clearly a downtrend. So do we think that this downtrend is going to just continue? Or do we think that the downtrend actually just had a 3-point reversal? So I'm going to give you guys 5 seconds for this one before we move on. Yeah, so this was actually a 4-point continuation. Almost really a perfect one here. L1, selling climax, right? Higher volume. H1, very high tail. L2, we do not break L1. We're still convincing retail that the market's going to go up. And then we get H2. H2, we quickly go above the high of H1 on good volume. But then, most importantly, we close right back into the range. Right about here-ish is where you might want to sell. Right about here, or short. At this point, many retail traders are probably convinced after the strong momentum that the market's just going to continue moving upward, and that this is a better price to buy at. And when that occurs, I mean, that's when the price goes lower. Okay, this one is interesting. Is this a 4 count? Is this H1, L1, H2, L2, or does this not appear like that? Does this look like a 3-point reversal? What do we think? 5 seconds. Yep, so this was actually just a 3-point reversal. Oh, no. Pardon me, this was a 4-point continuation. I said that wrong. Because we have an uptrend that turns into, continuation of the uptrend. Yep, so what occurs here? Well, this is a bit of a stranger structure because we do get a higher high made and then a lower low made. But the point that I wanted to show here was the point of recency. So let's say that you see a kind of structure that's not as clear, because typically we want to see a lower high made and then a lower low made, right? L1, L2. With this example here, if you do see a higher high made, it's typically more likely that it'll be bearish, especially with this market reaction. However, if you see this kind of structure being made, then you might just say that this is likely bullish, recency. If the most recent example was price closing a little bit below the low and then going back in the range, it's more likely the price will just continue moving upward than it is that price made a high here and closed back into the range, if that makes sense. So this is just an example to show that, of course, this theory isn't perfect. It can apply to a lot of markets, but there are going to be some wiggle room and some things where you might just have to go outside the theory and apply from there. So yeah, that would have been an uptrend. Here, I want to show this because this is just all over the place. This is just 3-point reversals and 4-point continuations. So if you want to pause the video here for 5 seconds before I reveal. I saw many 4-point continuations here. Yep, we go very quickly downward. We get retail to begin market buying on high momentum. We go back down. We do not go below L1. So we're still keeping those retail traders. We don't want them to hit their stop losses. No. We want them to buy. And we don't want traders to short. We don't want price to go down here and then them to begin to short, because we haven't shorted yet. We're institutions. We want to short and then maybe have retail traders short right after us, right? This is our method of convincing retail to trade after us at every time. Yep, we go H2. At H2, we get a swift reaction right back downward, trapping retail traders right above the high, and the market goes down. Yep. And we get another continuation here, continuation of the previous uptrend. We get H1, high, L1, H2, L2, perfect structure here. Lower low, lower high, price goes higher. However, this price didn't go too much higher. It did go higher, but it did not go too much higher, because maybe you could even reason that there was some kind of structure like an overall, if we were to go a little bit more zoomed out, that this was H1, that this was L1, H2, L2 here. Maybe, I don't see it because the market actually does go down. But the reason the market went down here is this 4-point continuation of the downtrend. We get a low made, we get a high, and then we get a low that's above the low here, keeping in the liquidity from those retail longs who market buy. We don't want to present the market as quite bearish, right? Because we need to sell before the retail traders sell. So we need to convince them that the market will just move upward. We do that here. We go above here, trapping retail traders, stopping out any shorts and taking their positions if we're an institution again. Then we go downward. Right? Okay, so this was a mammoth of a video. I think a 30-minute plus video that has been made. But yeah, so just to recap on why this is, on why this occurs and why this is going to work, with many different kinds of price situations, is the whole theory is based on, just like Wyckoff theory, the whole theory is based on filling the liquidity of the larger traders. Like we had explored about 25 minutes ago. Two things. One, we cannot just, if I'm an institution, I can't just place limit buy sell orders where I want. It's not that simple. I'm probably not going to get my orders filled. So what I need to do is to buy A, at a better price, and B, to get enough liquidity. I can press price to go below support. I'm buying at a better price, right? Then buying in the middle of the trading range. And additionally, I'm getting liquidity from all those stop losses being hit. And additionally, off of that, not only are long stop losses being hit that are selling right to my buy order, I'm convincing traders to short. I'm convincing other traders who are on the sideline, who might be investors or long, to sell as well because they see weakness. And then I get my orders filled. Yeah, so that's basically it. Just a few things to watch out for. Be very careful when buying lower lows, because if price goes much, much lower, not slightly below, that is not a stop loss hunt. That is just the continuation of a downtrend. What you want to see is low tails, if we're going to buy. Low tails or low momentum, with price barely going beyond support. Yeah, and same with the other way around. If you want to sell into, like let's say a 3-point structure. So price goes up and reverses with a 3-point structure, making that second higher high. Yeah, you don't want to see that second higher high closing above the trading range on high momentum and high volume, because what we explored with that example before, when that occurs, probably just a continuation of the uptrend, because the main principle here is price closing back in the trading range. When price closes back in the trading range, we've trapped the traders, we've trapped the longs, we've trapped the shorts, and we've convinced them to move. And then we move, us institutions. I'm hypothetically speaking, of course, I'm not an institution. We then trade, and then so like let's say we buy, and then to our happiness and profit here, when price goes up above the trading range, then retail begins to buy because they believe that they were wrong. The market's not going down, the market's going up. They begin to buy, which just fills our limit sell orders to profit, and then the price goes down, and the cycle will continue of burning retail traders. So that is how to hunt stop losses. If you would like this presentation, then I'm going to be sharing it on my Patreon. So if you want to join that, then you'll have access to voting, suggesting, asking me any questions you want, and you'll also have access to all these kinds of PowerPoint presentations on the Patreon. So yeah, with that, have a fantastic day.